Money Show.
Personal Finance with Warren Ingram.
Warren Ingram is a director at Galileo Capital. He's also a personal financial advisor, and this is a seamless introduction. Staying invested, Warren Ingram, it's like keeping your mute button off and staying active, because otherwise you're going to get let down and embarrassed.
And so interesting to have the conversation today when the JSE has taken a hiding. It looks like the American market's taking a hiding as well, and I'm assuming that the headlines tomorrow are going to be loud and terrifying, and then we're talking tonight about staying invested, and I think I always want to tell people that there are always really good reasons to be afraid of investing. There are always going to be really high quality, well-reasoned arguments about why markets might fall over now and why it's maybe not a good idea to invest just yet. Just hang on a bit. The corner's going to turn, the wheel's going to turn, and what I want to say is don't listen to that stuff. The problem is that when we're all fearful, when we're all afraid, and when the headlines are big and loud, that's usually where the market is offering us some great opportunities, and I feel when markets are collapsing and just really looking gloomy, that's the time to kind of switch your mindset from being fearful to saying, in bad market conditions, there is almost never a reason for me to be a seller. I need to be a buyer, or I need to be holding. And the only
almost. Hold on, let's just pause there for a second, Warren, and please don't forget your point, because I'm sure it was important. But you said there's almost never a reason to be a seller. The importance there is on almost. Please explain that.
So I think there, off the top of my head, there would be two reasons. One, in your very own sort of personal financial planning position, if you are invested, but you've made, and let's say you've made good investment decisions, and you own high quality investments that happen to have taken a knock because the whole market's down, then ordinarily you should remain invested and ride the tide and wait for things to turn. However, if you've got some other issues, for example, you're sitting on an enormous amount of debt, for your own position, or you're fearful of your job and you've got debt and you're not quite sure, that you'll be able to pay off your home loan on your house or whatever the deal may be, then by all means, take a wider view of your whole financial planning position to say, okay, I need to actually make a sensible financial planning decision, which might narrowly be a bad investment decision, because the bank's not going to understand me not paying my mortgage because I want to wait for the market to turn. The bank's going to ask me to pay my mortgage, and after that I'm going to start getting letters of demand. So I think that's the one good reason. The other one, to kind of jump back, would be January, February last year, we're starting to hear these noises of this coronavirus coming out of Asia, and we start to see countries looking at these lockdowns. Then you might look at let's say the South African listed property sector, and it's a sector which had an incredibly strong run for a very long period of time, but unfortunately sits on a lot of debt. And if you had some kind of inkling that the economy here would go into lockdown, then that might be a rational reason to say, well, hang on, I need to sell, because this is an event which could cause catastrophic damage to a sector. It's very specific, it's very narrow, and in that instance, I might be avoiding a lot more damage in the future. Having said that, there was no chance, for example, me sitting on air with you at that time, there's no chance I sat there thinking to myself, oh, well, this is a great time to sell the listed property sector. By the time everything had happened, and we all wiped our eyes, we had gone into lockdown. The market had taken 50% off listed property. So it's an easy one to understand in hindsight. But if you could see a very specific factor that causes a particular company or a particular sector to be severely damaged, and especially if they're carrying a lot of debt, then maybe that's a good time to be a seller.
Okay, but I mean, what we have learned, I think, through many, many market cycles over many, many years, is that the longer, more sort of market graph you look at, the less significant the periods of chaos, pain, turmoil actually appear to be. I mean, on a 100-year graph, 1929 almost doesn't feature as anything significant. However, had you been living through it at the time, it was catastrophic. And it is about understanding that, markets are for the long term. And if you look at recent market crises, we recover, markets seem to recover more and more quickly with shorter and shorter sort of refractory periods, if you like, when it comes to the big sell-offs and the bounces.
Absolutely. And I think, also to understand that no matter who the commentator is, no matter how intelligent they are, no matter how eloquent their argument or how strong their academic background or, how long their investment track record has been, we have to know that there is not a single market expert alive that can tell us what's going to happen in a week's time with any kind of confidence. They might, posit a fantastic argument, but that's all they can do. And how often, the big predictions are just horribly wrong. And the one, the one way to insulate yourself and protect yourself from that is to say, over long periods of time, if you stay invested, and you don't need to be a genius, you buy just a generic stock market unit trust or a stock market index, nothing particularly special. If you stay invested in the bad times, and if you can, you add to your investments when the markets are going badly, the markets do recover. The companies that are in those indices and in those unit trusts start to deliver good returns again. We don't know when, and we won't always know why, but what we know is that it does happen. Then all of a sudden, things start to go well, and we start to go on our way again. And I think that is the predictable thing we can say about investments. To try and say, well, we can see this economy is taking a tough time now. We think inflation is going to happen in America. We think gold's going to shoot up because, that always happens when there's inflation. Whatever the deal is, it's amazing how often those things that definitely should happen just don't happen. And that's the reality of investing is you can be really clever about markets, but the market will always humble you. And to me, understanding that you just need to stick it out, that doesn't require a lot of decision making. That just means do nothing and sit on your hands. And then always remember the sage of Omaha, Warren Buffett, who says, our favorite holding period is forever. And that's not a bad way to think about investing. It's just, if I've bought something and it's quality and it's diversified, maybe I should just sit on my hands, hold the investment and watch the space.
I think you're absolutely right, Warren, and the history books will prove you to be right as well. In times of uncertainty and chaos, the best holding period is the long term, and there are lots of articles online which you can find which will tell you the risks of selling at the wrong moment, because invariably you will sell at the wrong moment, and then you will try to buy back at the wrong moment as well. You can't go wrong, generally speaking, by holding out. In a moment, we're going to discuss with Warren on Freddie's instruction, because Freddie sent me a mail saying, please could you discuss with Warren the best mechanism or mechanisms for common people to take money offshore? It's a great question, Freddie. That with Warren in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Are preference shares still a thing? I'll ask Warren about that in just a little bit. But first, Freddie's question, Warren. Please could you discuss with Warren the best mechanisms for us common people to take money offshore? There's been lots of discussion about direct investment versus this versus that. I know that's the technical stuff. And tax and inheritance implications, etc., etc., etc. What should I do?
I think it is a brilliant question, and I think it's one that us common folk struggle with all the time. And so a couple of points to make, Freddie. And the first one is that you have to watch your costs really carefully when you're deciding to convert your rands to dollars, pounds, or euros, or whatever your currency of choice is, because if we look at the banking environment, they're typically going to charge you two sets of fees. They're going to charge you an express commission. So they're going to say to you, we're going to charge you 2% of the value of your rands that you want to convert into the foreign exchange. And then there is another fee, which is a bit more sneaky. And that's going to be the difference between the buying price of the currency and the selling price of the currency. And you'll always see that the one, there's quite a significant difference there. And the foreign exchange dealers, the banks and the like, are the ones that are making money on that difference. So there are two different and very clear fees that they charge. And so I think, looking at this, to me, the one trick is make sure that you try and do larger amounts than smaller amounts. So in other words, don't do your 5,000 Rand a month debit order where you're trying to convert your rands to dollars every month. Rather, let it accumulate over 3, 4, or 5 months and then convert, because often the banks will give you a discount. And then on that point, who else is out there? There are some foreign exchange businesses that specialize in helping individuals and companies convert their foreign exchange to convert their rands into foreign exchange. And they'll also do this for you, and they'll be quite clear and explicit on their pricing. So definitely worth shopping around. I think some of Freddie's questions around using Bitcoin, for example, I'm not convinced. I think that the volatility of Bitcoin is huge. To try and take cryptocurrencies and to use those to convert to an overseas investment, to me doesn't make sense. So I think definitely try and bulk up the money as much as you can, and bulking up is relative to all of us. We're not all billionaires, and so just make sure that you bulk up as much as you can. Definitely shop around. Ask the banks, to be clear on what they're going to charge you. Ask the foreign exchange specialists, and don't be afraid to ask for suggestions from friends and family. But make sure that if you're not using one of the recognized banks, make sure that the companies that you are using are authorized dealers with the Reserve Bank. You can check that. Make sure that there are financial services providers, so you can check that with the FSCA as well. They have to have a thing called an FSP number to tell you that. And so they just make sure that you do your homework and then shop around like crazy, because I think you can get better prices on foreign exchange conversion. Don't just accept the fact that it's on your bank and on your profile and on your app that's the best deal you're going to get. That's not always true.
Be careful also, of the simplicity of it, because just because it may be easiest to use your bank doesn't mean you're getting the best deal from them. But also, if you're going to transfer money from your bank to another provider, check out the fees on that transfer, for example, depending on the quantum of money that you're looking to transfer. When you talk about bulking up, if I've got 2,000 Rand a month to put away and I then save up to 10,000 Rand a month, is that going to be enough? Or do I need to be saving 10,000 Rand a month to get to 50? Or 20,000 Rand a month to get to 100? Or 50,000 Rand a month to get to 250,000 Rand? What sort of quantums are we talking about that is a decent enough amount of money so that the fees actually matter a lot less, Warren?
I think that it's that the golden rule of thumb, unfortunately, is that the bigger is always better. So the larger the amount, the lower the fees will be at some point, and the more negotiating power you have got. So to use your example of someone who's doing 2,000 Rand a month, I would probably do something a little bit different. I would probably say, start by, let's just say, by buying a Rand-based overseas index. Let's just say, you get the world index, and do a debit order into that for the next, 3-4 years, so that you're trying to lock in that exchange rate all the time. Every debit order, you're converting your rands into dollars in effect. And then when that amount is big enough, and I think big enough, truthfully, is probably more than 50,000 Rand, in fact, probably closer to 100,000 Rand at the least, to try and get some sort of negotiating power on your exchange rates. But to do, let's say, 3 or 4 or 5,000 Rand, I think you're in for a very tough time if you're trying to get a good rate on converting your rands to a foreign exchange.
And then be very careful where you put that money and where your investments are housed. Maybe this is a topic of discussion for another day, Warren, because I think it requires a lot more detail. Simply because the technicalities of the stuff are an absolute minefield in terms of capital gains taxes and which territories have got double taxation agreements with South Africa and which is the right sort of place to hold your money. And I think a lot of people get caught short when they go directly. They try and think they're saving money on costs and they don't get proper advice. And off they go and they go put their money in New York. And, one day when they die, they get nailed on capital gains tax, for example. Can you sum it out, rise it in a minute, or should we push it to another day?
I would love to have a proper discussion on this next week if we can.
Okay, we'll extend Freddie's question then to next week. Producers, please remember, Warren, please remember, because I won't. Do preference shares still exist, by the way? I was wondering about this the other day. Preference shares are a particular class of share. They feel quite old school. Are they still around?
They are still around. And so just to give a bit of background, what is a preference share? It's a bit of a hybrid. So it's a bit of a share on the one side, but it's also a little bit like a debt instrument, like a bond or almost a fixed deposit. So typically what happens is if a company wants to borrow money, and usually these will be large businesses that are already listed on the stock exchange, what they can do is they can go to a bank and they can go negotiate with the bank to lend them money, and that is one way to go. The other way is they might want to issue a bond of their own, and the third way is that they can issue a preference share. And what the preference share will do is that they will issue it, let's say, at R1 a share, and they will attach to that a promise, and the promise will be when our company is making profit, we will give you a percentage of prime. So for example, usually it'll be somewhere around 75% of the prime interest rate. So if prime, to make my math simple, if prime is at 10%, that means that you'll get a dividend from the company of 7.5% a year. Important point is that's only when the company is making profit. So it's not a guarantee, and it can change. So if the company decides we need to retain our cash, even if we've made profits because of COVID and we're scared of building up debt or something in the future, we're not paying out dividends this year, then the preference share dividend or the preference shareholder will be getting nothing. And so that's the first big thing to note. And the second is the price of dividend of preference shares does change. So I mentioned that they might issue them at R1. And if the market feels that interest rates are falling, you might see that the price of preference shares rise, or they might fall. If the market sees that interest rates are going to rise. So they're not guaranteed. There's no dividend guarantee at all, and there's no price guarantee. And so they have fallen out of favor to some extent, especially with dividends tax being implemented a few years ago. Preference shares became less and less popular, and especially for the banks, it wasn't something that they would take advantage of anymore because there were some banking regulations that changed and made them less popular for banks as well to raise money.
Warren Ingram, thank you very much. Warren is an executive director at Galileo Capital.